Yo, what's going on, guys? Welcome back to the channel. My name is Nate the Robber, and in this video, we're going to be going over 10 buy and never sell dividend stocks. So that is quite a bold claim for me to say you should buy and never sell them. You just buy and forget. That's kind of the goal here, and that's because of these companies' financial condition. A lot of these companies are very safe. They're actually dividend aristocrats and dividend kings, and a lot of people don't appreciate that. So what that means is these companies have risen their dividends for over 25 years. So they rose their dividends through 2008, 2020 pandemic. All of these things were no problem for these companies. And that's because these companies just print money. And let me show you the first stock I actually want to go over. So most of these stocks on the list I don't own, but a few of them I do own. I didn't just want to go over stocks that just I own because it look a little biased. But if I had new money right now, I'd probably be buying these new dividend stocks. But the first one I want to go over is a stock I actually own. It's ticker symbol EOG Resources. They're in the oil and gas industry, and they have a 2.87% dividend yield and a PE ratio of 10. Now, I'm going to tell you why I love this company, and that's because they have a rule where 60% of all free cash flow that they make. So imagine that. Imagine if this was Apple's rule. So 60% of all the free cash flow that they make will be returned to the investors through special dividends or stock buybacks. So this company is returning 60% of all the money they make to you and me as the shareholder. So look at this. This company has a huge history of doing special dividends. They just did, $1.50, $1, and they haven't done a special dividend recently, and I'm going to show you why. It's because they actually just did a lot of stock buybacks. But this is the free cash flow per share metric. This is my favorite metric to look at because it includes the stock buybacks or if they dilute you as a shareholder. But they made $5 in the most recent quarter. So imagine that. So they made $5 and their dividend per one quarter cost 91 cents. So they can cover their entire year of dividends just in one quarter of free cash flow. But that's off the free cash flow. This is their net income. They made $3.10. Well, let me just show you the net income. It was $1.79 billion. So they made $1.79 billion and their dividend from that cost $525 million. They actually made a lot more free cash flow than net income, but look at this. If you're wondering why it's more than 525 million, like why was it a billion? That's because they were paying out the special dividends, and they haven't done a special dividend in the most recent quarter because in the most recent quarter they bought back $759 million worth of their own stock, which is actually just over 1% of the entire company. So look in the most recent quarter. It went from 580 million shares outstanding to 574 million shares outstanding. So whenever they buy back their own stock, that helps the EPS, it helps the free cash flow per share, and it helps the investor. It gives investor returns. So look at this. This company has $5.29 billion of cash after spending $750 million on stock buybacks in the same quarter. And this company literally has more cash than debt. They only have $3.79 billion of debt. So this company is not going bankrupt. They are very safe, in my opinion. Hashtag not financial advice. And that's why they're almost at all-time highs. And the company just has a huge market cap of $73 billion. So that's why I chose EOG Resources as the first stock on the list. And that's why I actually own them. If I head over here to my Moomoo portfolio, I actually own 8 shares of EOG Resources, and on this channel, I'm completely transparent with all my holdings. So I want to show you exactly where I bought them. But anyway, let's go ahead and get to the next stock on the list. So this next stock on the list I don't actually own, but I really want to share it with you guys because they impress me every single time I look at their financials, and I really want to pick this stock up. I don't have any shares right now just because I haven't gotten to that yet. But soon, don't be surprised if I pick up shares of Comcast because look at this. They trade at a forward PE ratio of 9, and it's not like this is some commodity stock. This isn't EOG Resources where they sell oil. This is Comcast, and they have a forward PE ratio of 9 and a dividend yield of 3.26%. So here's how much their dividend costs them every single quarter. So it costs them 31 cents every single quarter. They do have some good growth. If we head back to 2020, their dividend used to be 21 cents, but it cost them, remember, 31 cents in the most recent quarter, and just in EPS, they made 96 cents. So, they can afford 3 quarters of dividends just in 1 quarter of EPS. But let's actually go look at the free cash flow per share. They actually made $2 in free cash flow, which covers the entire year of dividends. So that's why I'm saying this company has so much room to organically raise their 3.26% dividend yield. And if you hold these in a taxable account, these companies pay qualified dividends. So they're not like REITs, they're not like BDCs. So you get, for me, if I hold this stock and receive a dividend from them in my taxable account, the dividend rate will be zero. I'm taxed 0% with my current income tax. But check this out. Their free cash flow in the most recent quarter was $7.85 billion. Remember that number, $7.85 billion, and their dividend literally cost $1.19 billion. So they can afford the entire year of dividends, like I said, just in one quarter, which is what I love about the company. So since they have so much free cash flow left over, what are they doing? Well, they're spending twice as much money on stock buybacks than they are on dividends. Remember, their dividend just cost them $1.1 billion a quarter. They spent $2.66 billion just in one quarter on stock buybacks. The quarter before, they spent $3.5 billion. So this company is buying back all of their stocks. So if we actually go to their total common shares outstanding, I actually didn't know this. So this is why this company is so impressive. You now own 5.84% more of the entire company on top of the 3.6% dividend yield. So as a total shareholder yield, you get a 9% yield in a perfect world. You get what I mean right here? And this company is trading, I don't know how this company is not at all-time highs. I guess their moat has been getting hit. I'm not really this video, what I'm doing here is pure financial analysis. This isn't looking into what the company does really, because I'm just looking at their net income and doing a payout ratio based off that. So their net income is only up 0.27%. So look at this, their net income's up 0.27%, but their EPS is up 6.53% because of the stock buybacks. All right, so for the next dividend stock, we got the worldwide, world famous McDonald's. But did you know this company is almost at a 3% dividend yield? Isn't that kind of crazy? And they're trading at exactly, for right now, $250 per share. But this is what's crazy. The forward PE ratio for McDonald's is literally 20. So I don't know about y'all, but that's insanely cheap. We almost have like an M forming on the chart here, but I'm going to show you why this company has so much room to raise their dividend. And this is McDonald's we're talking about. This isn't some speculative dividend stock. So look at this. Their dividend per quarter cost $1.67. Let me show you the dividend growth rate, because the growth rate of the dividend is super impressive. In 2020, the dividend was $1.29, and now the dividend is $1.67 per share. But remember this, their dividend cost $1.67, and in free cash flow per share, they made $3.31. Why is McDonald's stock down? Look at this. It's kind of down from 1 year ago. That's because look at the free cash flow per share. It's only up 0.02%, which is a little disappointing. They're starting to not grow their free cash flow per share as much. We can also look at the EPS, earnings per share. The net income per share was up 8.45% year over year. So that's really good for McDonald's. But look at this. Let's actually go to their free cash flow. So they made $2.39 billion in the most recent quarter. So they made $2.39 billion, and their dividend literally cost $1.21 billion per quarter. Very safe dividend payout ratio. And if we go to the diluted weighted average shares, you now actually own 1.31% more of the company. That's because they're also doing stock buybacks. Wow, they spent $800 million in the most recent quarter on stock buybacks. They're nearly spending $1 billion per quarter on stock buybacks. And whenever, McDonald's buybacks their stock at these discounted prices, it's really good for the shareholder long term. McDonald's has total debt of $37 billion, down from the previous quarter. But remember, if they can spend $800 million, nearly $1 billion every single quarter on stock buybacks, we know if they wanted to, they could easily pay down this debt. But they're choosing, since they don't have a super high rate on their debt, why pay it off right now, So their retained earnings were $64 billion. This is McDonald's. There's not much more to say about them. I just wanted to show you their financial condition and why right now could be the perfect time to enter for the long term or start dollar cost averaging into this amazing company. Because when rates go down and the consumer's doing good again, McDonald's is going to start going up. All right, so the next stock on the list has literally been flat for the past 2 years. This is United Health Group. They are a huge company worth $450 billion, but the valuation is really cheap right now, in my opinion. Check this out. Look at the forward PE ratio of 17.64. That's cheaper than the S&P 500 and the NASDAQ, all those tech stocks. This is an insurance stock, United Health Group. But look at the dividend yield of 1.71%. I'm going to show you why they have so much room to raise that 1.71% dividend. Now, since this is an insurance stock, you want to look at certain metrics like the total premiums earned. Now, this is super impressive. It's at $98 billion in the most recent quarter, which is up 8.4% year over year. Their total premiums earned is literally gone gone up in a straight line. There's never been a red decline in their total premiums earned. And that's what's crazy. Have you heard of like the law of big numbers where it's hard to keep growing your already billions of dollars? Well, they are doing it at an inflation beating rate of 8.4%. And look at their net investment income. This is what they can do with their cash and customers' cash. And you want to be an insurance company right now because you can keep your cash in the money market funds, the risk-free 5% yields. And look at this. So this company spent $1.73 billion on their dividend per quarter. That's how much their dividend cost, $1.73 billion. And they're spending way more on stock buybacks. So I love companies that do dividends and stock buybacks. But since they don't have a crazy high dividend payout ratio, they're able to give you returns through stock buybacks. And they spent $2.6 billion just in the most recent quarter on buying back their own stock. So that's why if we actually go to their diluted weighted average shares, you now actually own 2.23% more of the company on top of the 1.71% dividend yield, which gives you a total shareholder return closer to 4-5%, which is crazy. So that's actually why I'm recommending United Health Group. It's because of their valuation, their dividend metrics, and this is a huge company in America. Everyone has like their insurance through them. $450 billion market cap, and they still have room to grow. Not financial advice, but that's United Health Group. All right, guys, so for the next dividend stock, I actually own this one here in my Robinhood portfolio. This is Realty Income, ticker symbol O, and they are famous because they pay monthly dividends. They are the biggest triple net lease, a REIT, which is a real estate investment trust. So we're going to look at them a little differently than your traditional dividend stock because these stocks have certain tax rules, but I'm going to show you why I love this company's monthly dividend, and they have a lot of room to actually raise their 6% monthly dividend, which sounds crazy. So look at the market cap. It's $45 billion. So they are a pretty big company. They are in the S&P 500, so there's a lot of safety right there. And they are a dividend aristocrat. So they have not cut their dividend for over 25 years, but they've risen their dividend every single year. So check this out. This is their balance sheet. What's impressive is they're able to grow their assets and stay at the same debt to assets ratio at 42%. So look at this. 1 year ago, they had $51 billion of assets. Now they have $68 billion of assets. And what a lot of people are saying is the high interest rate environment is actually a barrier to entry for new people to come into the market. So because this is a publicly traded REIT, they're able to issue equity and gather up all these amazing assets for cheap. So look at this. This is the number we actually want to look at. I'll get into that a little later, but I'm going to show you their dividend payout ratio. They made $778 million in the most recent quarter, and their dividend from this cost them $639 million. So if you're still like that payout ratio still seems kind of high, REITs have to, by law, pay out 90% of their taxable income in the form of dividends, or else, they pay taxes on the money. So that's what I really just wanted to show you, that when we look at their actual revenues, they have room to raise their 6% dividend yield. We don't look at the PE ratio because you never look at net income for REITs because you have to add back the depreciation and the amortization to the net income to get their core FFO, which is what you pay out the dividend from. If that didn't make sense, don't worry, because we're going to get into the next stock, which is not a REIT, but it's actually a MLP. So it's actually ticker symbol EPD. Now, this company, even at all-time highs, has a dividend yield of 7%. And look at the metrics, the valuation metrics, PE forward ratio of 10.79. But they are similar to Realty Income as they have to have this super high dividend yield by law. They have to pay out the income that they make by law. And I'll show you that right now. So in the most recent quarter, well, let me see how much their dividend costs. So their dividend cost them 51 cents every single quarter. And let's see how much they make in free cash flow per share. They made 97 cents in the most recent quarter. Like, look at this. When was the last time it was ever under 51 cents? This company has very stable free cash flow coming in. So as we can see, they can easily afford the dividend, if not have room to raise it. But here's what we want to look at down here. Let's go with the bad quarter. Look at 1 year ago. They made $1.58 billion. So we're going to assume a really, really bad quarter for them because this company is oil and transportation based. They are an MLP. They have oil transportation commodity services. Anyway, so remember, I already forgot. They made, on a really bad quarter, $1.58 billion. Hit the like button for me. I'm struggling out here. And their dividend cost $1.12 billion. So they have a lot of room actually to raise the dividend if they wanted to. And here's another great thing. Even though they have a 7% dividend yield, you have not been diluted as a shareholder. Well, you've actually only been diluted 0.92% year over year, which is literally nothing. Most stocks that have a super high dividend yield are at the same time diluting you. Well, this company, EPD, is not doing that at all. And they have a huge market cap of $63 billion. So this is a huge company. Again, I don't really talk about what the company does. I'm just here to show you their financial metrics and their payout ratio, stuff like that. So that's why I included EPD as part of my buy it and never sell. Not financial advice, not personalized advice, but because they're huge market cap, they're good valuation, and they're good yield. All right, so the next dividend stock on the list, we have Hershey's, ticker symbol HSY. I love this company because they're right at a 3% dividend yield. They're trading at a very fair valuation at a 19 forward PE ratio, and I have a lot of good things to say about this company. I literally think their brands are going to be here for another 50 to 100 years. America is on their side with Halloween, Valentine's Day, gifting. There's all these little things that Hershey's benefits from, and they're a dividend growth stock. I mean, if we exclude the previous, couple months here, this company has basically been straight up, and the metrics align with that. I'm going to show you why this company is super impressive. So like I said, they have a 3% dividend yield right now, and their dividend cost $1.37 per quarter. Now, what's super impressive is the dividend growth rate. In 2020, their dividend was 80 cents. So it went from 80 cents to $1.37. It's almost close to a double in dividends. But check out their earnings per share. This is what a lot of people aren't talking about, which I noticed about Hershey. They just had an all-time high EPS in the most recent quarter. Now, I know the quarter before was a little bad, but in the most recent quarter, they hit an all-time record for EPS. They've never had a higher EPS quarter than in the most recent quarter. That's what I really like about Hershey's. We can also look at their free cash flow per share. It was $2.88. And of course, no matter what metric you look at, the net income or free cash flow, it well covers the dividend of $1.37. But let me actually visualize the numbers for you. So in the most recent quarter, they made $569 in free cash flow, or $779 million in net income. They basically made very close to the same amount of free cash flow and net income when you average out the 4 quarters. But anyway, let's see how much their dividend costs. So their dividend literally only cost them $273 million per quarter. And why did it go up in the most recent quarter? That's because they're choosing to raise their dividend, which I love about that. And we can also look at the diluted normalized EPS. Like I said, they made $3.22. It is a record high EPS for them, which is super impressive. But let's also show you this right here. If we go to their total common shares outstanding, where is this? You now actually own 1% more of the entire company. That's because they're doing these stock buybacks. So not only do you have a 3% dividend yield, but they're also getting returns through stock buybacks. Look at this. They bought back just the most recent quarter, $490 million of the entire company. Wait, hold on. $490 million. How much of their market cap is that? Because that's like 5 to 10% of the entire company. Wait, hold on. Am I crazy? We can also look at some other metrics like their retained earnings. It's at all-time high as well at $5 billion. They have $520 million of cash even after spending nearly $500 million on stock buybacks. So that's what's really impressive about Hershey's. I don't see anything happening to them. What's really been hurting them recently is the commodity price of cocoa, which, a lot of their sales are from chocolate. They sell chocolate. Whenever the price of cocoa and chocolate goes up, it artificially hurts their margins. And as commodities should always go down. So as cocoa goes down, it should in theory just help Hershey's. All right, guys, the next stock on the list is ticker symbol MSCI. This is like the ultimate dividend growth stock in my opinion. I want to go ahead and show you their financial metrics. This video is getting a little long, so I'm going to try and go faster through these last 3 dividend stocks. If you're enjoying this video, don't forget to drop a like on the video and let me know in the comments if you're enjoying this because I love making these videos. But check this out. They have a huge history of growing their dividend. Their dividend went from under $1 in 2020 to now $1.60. So that already is super impressive. So remember, They made $1.60, and their EPS in the most recent quarter was $3.21, which is up 8.53% year over year. So if we look at their EPS, they could double their dividend right now, no problem, based off their net income. Let's go to their free cash flow. They made $3.78 in the most recent quarter, which was up 14% year over year. So no matter what metric you look at, the free cash flow or the EPS, they have a lot of room to grow. And that's the thing. They're growing their net income. Like, look at this. This is inflation beating. Like, look at the green year-over-year growth rates at the bottom. Like, the quarter before, it was up 87%. Let's go to their free cash flow down here. They're growing this as well to $300 million. So no matter what metric you look at, it's super impressive. But remember this number right here, $300 million. I want to show you how much their dividend cost them. So they made $300 million, and their dividend literally cost them just $131 million. So that's why I'm saying they have room to double their dividend. On top of that, you also own 1.21% more of the company, and you can probably guess why. It's because, of course, they're doing stock buybacks. You know, about a year ago, they spent $440 million on stock buybacks. So it's good to see that this company is, focused on giving investor returns through dividends and share buybacks. And they've been buying back shares, over these recent dips. This company has actually been very volatile. Like, despite it's like slowly going up, but it's been very, very volatile. So that's MSCI. The yield may not entice you. It's 1.3%, but in 5 to 10 years, they're going to be growing their dividends so much faster than any other dividend stock out there. Just my opinion on that. But the next dividend stock, I want to show you one that's super impressive. They are in the S&P 500. They have a market cap of $15 billion, but I'm going to show you why I don't believe this. So look at this. Their dividend yield, is 2.19%. But look at the metrics, the financial metrics, the valuation metrics, I should say. They're trading at a PE forward ratio of 5.93. So they're literally trading at 6 times net income. Look at the market cap. Market cap of $15 billion, and they made a net income in the most recent quarter, $733 million, which is actually up 100% year over year, which is super impressive. And we can also look at their free cash flow down here, which is the more stable metric we actually want to look at. But remember, it was $1.1 billion. Let's actually look at this on the per share metric. So this is the free cash flow per share. They made $25 in the most recent quarter, and their dividend from this cost $2. Literally $2 every single quarter out of this 25. And that's off their free cash flow. Let's go to their EPS. They made $16 in EPS, and their dividend cost them $2 per quarter. So the most recent quarter of EPS pays for the entire year of dividends and double that. So yeah, they could, in theory, have like an 8% dividend yield, and they could easily afford it. So that's what I love about the company. You have been diluted as a shareholder. They actually just did an all-stock merger with another company. That's why you've been diluted 10.85% year over year. That's why, look, their free cash flow was up 3.57%, but their free cash flow per share was down 6.93%. Either way, the dividend is super incredibly safe. That's what I think about ticker symbol EG Everest Group. All right, guys, now I'm going to go over the final dividend stock on the list. If you made it to the end of the video, seriously, thank you so much. It means a lot to me. But the last stock I got to go over is ticker symbol CSL or Carlisle. This is actually my largest holding of any stock, and it's that way for a very good reason. There's not a single metric that disappoints me about this company. Look at the forward PE ratio of 22. This company is actually 2 years away from being a dividend king. They have 48 years of dividend growth, and their dividend payout ratio is 22% based off their net income. It's even less when you look at the free cash flow per share, but look at the dividend growth of this company. Like, just if we scroll at the bottom, it was 54 cents. Now it's 85 cents. And let's see what their EPS is. In the most recent quarter, it was $4. So the most recent quarter of EPS pays for the entire year of dividends. Just the most recent quarter of EPS. And let's go to the free cash flow per share as well. The quarter before, they made $8. So in the trailing 12 months, Carlisle has made $17. and their dividend cost them $3.40 for the entire year. And they have a very safe balance sheet. So let's actually go look at their free cash flow. So look at this. They made $163 million. The quarters before they made like 400, 500 million. But look at this. You now actually own 5.65% more of the company. So that right there is like a 6% non-cash dividend yield. So on top of the dividend, you now own 5.65% more of the company. But let's go to the stock. That's because of the stock buybacks. I mean, look at how much they're spending on stock buybacks. The market cap of this company is only $19 billion. So when they spend $300 million, that really means a lot for the company's numbers. So that's why, like I said, you now own 6.3% more of the company when we look at total common shares outstanding. So after doing those stock buybacks, they still have $552 million of cash on hand. Let's go to their total long-term debt. Look at this. They're paying off all their debt. You know, they had $2.28 billion. Now they're at $1.89 billion. But yeah, guys, those were my 10 buy and never sell dividend stocks. If you made it till the end of the video, let me know in the comments you are a real one. And don't forget to hit the like on the video and subscribe if you like how I show you all the numbers. And I'll see you guys in the next video.